Don't use tax-deferred IRAs and 401ks for your retirement. Accumulate your money totally income tax-free. In this educational episode, I'm going to be addressing the fourth key element of a prudent investment, which is the tax advantages that you can achieve, and it's not in a tax-deferred IRA or 401k or in a Roth IRA or 401k. Get ready, I'm going to explain why. So I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for nearly 5 decades, helping people prepare for a comfortable retirement and also other long-term goals, such as college funding for their kids and grandkids. Maybe it's working capital for business owners or real estate investors and so forth. But I've always shown people my favorite financial vehicle that passes the liquidity test, safety test, rate of return test, and the tax advantage test with flying colors is a properly structured, max-funded indexed universal life insurance contract. If it's structured correctly and funded properly, it is deemed a laser fund. Now, LASER is an acronym that I've used for years that stands for Liquid Assets Safely Earning Returns. I've been very honored in my career to have authored 12 books. This is my 11th book, and it has been flying off of our warehouse shelves. We're in the 8th printing of this. And at the end of this episode, I'm going to gift you a copy of this book. It retails on Amazon for $20, plus you'd pay another $10 or so for shipping and handling. I'll gift you a copy free. Stay with me to the end because you're going to want to study this. Now, when people have come to me to prepare for retirement, many times, where do 91% of Americans have their money? Usually in tax-deferred IRAs or 401ks invested in the market. And so when you look at IRAs and 401ks, even the original champions of the 401k lament the day they ever came up with that idea. It got away from them, and it was never designed to be the primary retirement planning vehicle. A 401k is a defined contribution plan. It used to be years ago, we had defined benefit plans, and that meant that the benefits for working as a school teacher for 30 or 40 years were calculated based upon the years of service that you taught, and you got 2% for every year of service of your last average paycheck and what have you. That was a pension. That was a defined benefit. Then they wanted to get off the hook of having to manage pension funds because a lot of pension managers were not doing very well, but they were still on the hook to have to cough up that money when their employees retired. They didn't want that responsibility anymore, so they introduced a defined contribution plans. You define how much you want to put in up to the IRS limits, and you get to decide where it's invested. But if you make wrong choices, that's your problem, okay? It's no longer the company's problem if you don't have sufficient retirement, okay? So that's a defined contribution plan. Well, it has not worked very well because a lot of people have their money invested in the market. A lot of people get duped, I think, into being told they're going to be in a lower tax bracket when they retire. And I've noticed if you're a saver, you will likely not be in a lower tax bracket when you retire. You'll be in as high or higher tax bracket as you've ever been in because most retirees have been going down the highway of life trying to achieve this destination of financial independence, and they've been driving with one foot on the gas pedal and the other foot on the brake pedal, and they didn't know they were doing it. The foot on the gas pedal is putting money in tax-deferred accounts, IRAs, 401ks, 403bs, 457s, and so forth. But the other foot was on the brake pedal. They were killing their tax deductions, paying off their house. The kids end up, of course, getting older and they move out. If they move back in, you can't deduct them anymore. So you lose those deductions. You're not contributing money to IRAs or 401ks during retirement. You don't have those deductions. If you're a business owner and you sold your business, you don't have those deductions anymore. And what does government do? They keep spending more than they bring in, and so they keep raising taxes. Folks, most retirees, if they saved money, are paying as much or more in taxes as they've ever paid. So the premise that you're going to be in a lower tax bracket has not been true or axiomatic now for over 30 years. Now, a step in the right direction might be a Roth, but on this channel, I've posted many educational videos stating I've never owned an IRA or 401k. Yeah, never will. But I've never owned a Roth IRA or 401k, and I never will. And I'll explain why here in just a moment. But whenever you set aside serious cash, you want it to pass the tests of a prudent investment. The key elements of a prudent investment are, number one, liquidity, the ability to access your money when you need it. Number two is safety, not only safety of the institution, but safety of your principal. Anytime I set aside money, I don't want to lose what I set aside, but any year I make money, I want that I made this last year to become newly protected principal so I don't lose what I made in previous years in future years. I don't want to lose that, okay? A lot of advisors don't know how to do that. Indexed universal life actually can do that. That's why it's one of my favorite instruments. The third key element of a prudent investment is earning a predictable rate of return. Now, there are some years on my favorite vehicle, a max funded indexed universal life, that I have been credited 25%, even 61.33%, and even 158% using multipliers. But that's not true year in and year out. I've usually averaged between, 7 to 11%. Ever since 1997, I have been able to average at least 9.62%, actually all the way back to 1980. But when I diversify, okay, and I also rebalance, then I'm able to tweak the rate of return to an average of 11.17 since 1997 when indexing came out. And I'm able to earn a little over 11 and net a little bit over 10. So what's that 1% difference? That is the cost of the insurance that the IRS says has to be there in order for it to be tax-free in the Internal Revenue Code. But hello, I'd rather earn 11 and net 10 so that every $1 million I accumulate can generate a 10% payout, $100,000 a year of tax-free income without depleting principal. Because to have a net of $100,000 to buy gas, groceries, prescriptions, and golf green fees, to have a net of $100,000 after tax and fees in the financial services industry with money in IRAs and 401ks, which is yet to be taxed, and they charge you a 1% asset management fee, I'd have to be earning 16% in an IRA or 401k in a mutual fund. Because I earn 16%, and I pull out the money, I have to pay a third of it in tax, and I have to pay 1% in fees. So I have to earn 16 to net 10. I'd rather earn 11 and net 10. But see, the fact of the matter is most people who have their money in the market in retirement, they're not averaging 12%. They're lucky if they average 9. But if you pull out $90,000 a year out of $1 million nest egg, you're only netting $60,000 to buy gas and groceries after tax, and maybe only $50,000, 5%, after taxes and the 1% fee they're charging you on that $1 million they're managing. That's unacceptable to me, okay? This is why so many retirees, when they have their money invested in IRAs and 401ks in the market, they do not want market volatility. So what happens is when the market starts to go down 15, 20, 25%, they go enough already because they see their $1 million nest egg dwindle down to 600,000 or 700,000, and they sell. They get out of the market when it's low, and then they wait until it comes back up again, and then they buy high. So Dalbar, who studies investor behavior, says that the average retiree with money in the market is only averaging about 3.49%. That's pretty bad. And so that's what precipitated the 4% rule in the financial services industry. They only want you to pull out 4% a year because they don't want you to sue them for outliving your money. That means on $1 million nest egg, they only want you to pull out 40 grand a year, and you're paying even 25% in tax. 10 grand, you're netting only 3%. If you subtract the 1% asset management fee, you're only netting 2. Do you want to net 2 or do you want to net 8 or 9 or 10? How much more is 8 than 2? That's 4 times. It's 400% more. I'd rather have $80,000 a year of income out of $1 million nest egg, not a net of $20,000 after taxes and fees. This is huge. So when we talk about the key elements of a prudent investment, I want to have liquidity, safety, and predictable rates of return, but I want to have it be tax-free. Now, in the Internal Revenue Code, okay, for 108 years, there's only one financial instrument that allows you to accumulate your money totally income tax free and then be able to access that money income tax free. And then at the end of the day, when you die, anything you leave behind increases, it blossoms, and transfers income tax free. And that is an insurance contract. Now, what you're doing is you're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most money, the most premium the IRS allows to use it for a living benefit for retirement. Now, when you structure it correctly and fund it properly, you can, over the life of that contract, achieve, like I have, a rate of return within 1% of the gross rate of return. So that if you can average by diversifying and rebalancing 11, you can net 10. But if you average 10, you'll net 9. If you average 9, you'll net 8. But that's far better than a 4% payout from a mutual fund, IRA or 401k, and then only netting half that because of taxes and fees. Is this making sense? So the last concept with tax advantages, which is the fourth key element of a prudent investment. And on my book, The Laser Fund, these four pillars stand for liquidity, safety, ready return, and tax benefits. And you can rank any investment on a scale of 1 to 10 with relation to liquidity, safety, ready return, and tax benefits. Where most Americans have their money, it only scores maybe 18 to 22 out of a possible 40 points. Whereas the Laser Fund, a properly structured IUL, scores 33 or 35 out of 40. There's nothing that scores a perfect 40, but nothing comes as close as the Laser Fund does. So the final question I get asked is, well, why is this better than a Roth? A Roth has two benefits. Your money accumulates tax-free and you can access the money tax-free. It was introduced in 1997 by Senator Roth because the government was hard up for tax revenue. And they said, you know what? A lot of smart investors are realizing that they're not in lower tax brackets when they retire. They would rather get the taxes over and done with sooner than later, while account values are less and tax rates are less, rather than thinking taxes in the future will be lower. So let's let these Americans roll their money over to a Roth, and that triggered tax revenue because the government was hard up for tax revenue. They did it for them, not for you. It was a step in the right direction, but I've never owned a Roth, IRA, 401k. Why? Well, why would I mess around with the strings attached? What are they? Well, see, you cannot touch the money you put into a Roth for 5 years or till you're 59 and a half without a 10% penalty. I don't want that restriction. In fact, if you make too much money, you can't even participate in a Roth. Savvy CPAs and tax attorneys refer to the Laser Fund as the rich person's Roth. So the four additional benefits, I can structure a Laser Fund to accommodate $30,000 a year, $300,000 a year. I don't have to put in $300,000. I can put in $30,000. But I can make up the other $270,000 anytime I want. You can't do that with a Roth. If I put in $300,000 and 30 days later I need to access $200,000 of that for an emergency or an investment opportunity, I can do that. There's not a 10% penalty. I don't have to wait till I'm 59 and a half. And I can use indexing with a Laser Fund. That allows me to participate when the market goes up, but not lose when the market goes down because my money is not invested in the market. You can read and learn how indexing works. I'm not talking about an index mutual fund. But at the end of the day, if I die with a Laser Fund, it blossoms. If I die tomorrow in an accident, I'm 71, every million I might have in a portfolio of Laser Funds would blossom to as much as 2 million and transfer tax-free. There's not a Roth around that will do that. And people say, how much does that cost? Well, it doesn't cost me anything. It's not free, but it doesn't cost me anything. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax. So that's why it's my favorite vehicle. If you want to learn why, study my book, The Laser Fund. It's 300 pages. 200 pages is comprised of charts and graphs and explanations for the left brain learner. If you're a right brain learner, you just flip it over. And this is 100 pages, 12 chapters with 62 actual client stories. So go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats available. There's a master class you can invest in. You can register for one of our educational webinars. They're free. We teach them on a regular basis. You can even schedule an appointment to talk to an IUL specialist that are the top, the creme de la creme, the top 0.1% that I have trained, that I oversee, so that with no cost or obligation, you can see how a laser fund could be structured correctly in your particular set of circumstances.